And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. That means Jonathan Penn is joining me this morning. And it is also, unfortunately, tax day, which means that you have until midnight to file your taxes tonight or get your extension in, and make sure that you have if you're doing an extension, make sure you make your estimated tax payment. Otherwise, you get some penalties for that. So, the rush is on. Of course, it's not nearly as bad. I mean, I remember, back in the day, pre-turn of the century, when my kids were convinced we all lived by candlelight lanterns. You actually had to, fill everything out on paper, get it down to the post office, and get it mailed. You had to have the postmark by midnight of tax day, get it in, and of course, there was always lines at the post office, on tax filing day. But that's not the case anymore. We've evolved into the new 21st century where we do this electronically now. So, get out your Intuit or your QuickBooks, right? And file your taxes, get it done, get it submitted. A couple of things around that. First of all, part of one of the things that will happen now post tax day is that we start getting refunds, and refunds tend to flow back into the market. So if you're looking for a positive piece of spin on tax day, it does tend to help the market after tax day because of refunds coming back. Also, after tax day, we start getting back into corporate share buybacks. We've been in blackout now for the last couple of weeks. Corporations are now announcing earnings over this week and next week. We will have a whole just kind of surge of corporate earnings reports, including the big Mag 7, well, most of the Mag 7. we'll be reporting. That opens up the window for corporate buybacks. Once they announce, they can start buying back shares. So one of the supports for the market that's been missing has been corporate share buybacks, and that's been a big support for markets over the last few years. Well, actually since the turn of the century when we started this, but it's been a big driver of asset prices and it's really accelerated in recent years. So that support for the markets will come back and tow here over the next 2 weeks. So that's also good news following into the end of the month. However, once we get to the end of the month, we do start winding up the seasonally strong period of the year, typically get into a little bit weaker price action. Of course, last year we had the yen carry trade blow up during the summer. Year before that, we had a 10% decline during the summer. So things tend to happen during summer months. And again, that certainly suggests that the recent bout of volatility in the market we've had is not behind us. But taking a look at a lot of the technical backdrop of the market, where markets are currently trading, deviations from moving averages, those type of things, it does suggest that probably this recent low that we saw in the market may be the low here for a little bit. So we'll see. There's a difference between event-driven corrections and structural bear markets. And, one thing we don't have right now is the structural bear market part. Structural bear markets are generally related to things like the subprime crisis or the dot-com crisis. And we don't have any of that going on right now. But we do have an event-driven narrative over tariffs, and that's certainly weighing on markets here near term. And has had a decent impact to it. And we're reversing some of that overvaluation that we had in the market. So that's good news for the bulls, right? A lot of the bears are always talking about, hey, we have all this this market's so overvalued, it's going to have to correct. Well, it corrected. So we worked off some of that overvaluation. Not a lot of it, but we did work off some of it. That does typically help the markets try to find some level of support. And if we can work through these tariffs, etc., then that's going to be more helpful. With a lot of news from the White House talking about, countries are lining up to make trade deals. And the question now is in fact, Kevin, I never read the short bus, Hassett was out yesterday talking about spinning his views on this, saying, well, you just can't decide whether to announce them one at a time or all at once. And I would suggest announcing them as you get them would be helpful to let people know you're actually making progress. But, Kevin is also, I have very fond feelings of Kevin. Anyway, Kevin Hassett also said there's absolutely 100% chance that there will be no recession in the U.S. this year. So he's putting it all on the line, saying no recession this year, so that'll be good. But again, we'll find out what's going to happen. But that's really kind of driving the market. One of the big narratives, though, is the dollar. And that's what we're going to talk about right now. Here's what you need to know before the bell. The dollar has been under pressure. And of course, this recent narrative is nobody wants the dollar. Everybody's selling the dollar because, it's the end of the world order as we know it, and it's de-dollarization. Nobody wants to own U.S. Treasuries anymore. It's just absolutely terrible. It's just this massive decline in the dollar. And it certainly has been a pretty decent decline in the dollar. We went from about 110 to 99 on the U.S. dollar index. Very, very important here. That is mostly nonsense because you have to put things into some context. I put a post out last night about this as well. Yes, the dollar has been in decline, but again, if we switch this, as is always the case, to looking at a little bit kind of a longer term time frame and putting this into some level of perspective as we go through this, you start to see a very different picture emerge about the dollar. So this is a monthly chart of the dollar going back. Let's just go back 20 years to make it easy. This is a 20-year chart of the dollar. Does that look like a dollar collapse to you? I mean, this is, yes, the dollar is declining here. We've been currently trading. We were extremely overbought on a technical basis after this massive rally that we had over the last couple of years in particular. And remember, just about 2 years ago, Michael and I were writing articles about there is no de-dollarization going on. The dollar had been declining a couple of years ago, and it was all about de-dollarization in the markets. And we had this little fall off in the dollar here, right here in 2020. And it's like, nobody wants the dollar. It's all de-dollars. It's the debts. It's the deficits. It's, oh my gosh, it's panic. And that was the actual bottom of the dollar right there. And then we had this huge rally in the dollar post that. Got extremely overbought on a technical basis. Been working off that, basically just been consolidating in the dollar now for really ever since 2022. Really haven't gone anywhere in the dollar. Yes, we could certainly go a little bit lower. 91 on the dollar index is certainly possible here. That's a retest of a very long-term moving average. Technically speaking, that would still be well within the bullish trend because, again, if we kind of back this up and just look at a long-term basis of the dollar, we've been in a consistently rising trend ever since 2008. But again, we've had these variations in the dollars over history, and it's just a balance of currencies and trade. So again, not surprising with tariffs going on, where if I'm a foreign country and I have reserve assets, where do I store them? Well, I store them in US dollars because it's stable and it's safe. Well, if there's something going on, say for instance, you're going to impose a tariff on me, or if there's something going on in the financial markets where I need to recall my reserve currency because maybe my currency is going up relative to the US dollar, so I don't want to lose money in my reserve assets, so I pull them back into my currency. That happens, right, from time to time. And so we see this movement of flows relative to what's happening in currencies because basically currency is nothing but a measure of trade internationally. And for most countries in the world, they store their reserve assets in US dollars. How do I store reserve assets in US dollars? Well, I can buy US Treasuries. I can buy gold because it trades in dollars. I can buy US stocks. And that's what's been going on. And so now that we have this tariff impact coming on, and people are concerned, countries are concerned about the impact of tariffs on their economy, if they pull their reserve currency back, they can pull it out of treasuries, they can pull it out of stocks, and we've seen that rotation here lately. That's exactly what's been going on. So again, don't get too wound up in these big kind of overall metric, kind of headlines about de-dollarization and all this. 70% of the world trade still happens in dollars. That's not going anywhere, even with tariffs, because it's a highly liquid, highly safe currency that everybody uses for global transactions. That's not going to change. We may go through variations, may go through short-term blips in asset prices, but again, you got to keep this in some type of perspective. And again, just, we were extremely overbought, working that off. But that's what you need to know before the bell this morning. We'll be right back after the break. Pick up with John Penn. More stuff to get into. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, few last minute to-do items today for tax day. If you haven't done them yet, there are some things, and I've begged y'all before. Don't wait until the last minute to do stuff. Like I got a call yesterday in a panic from the bank needing to verify a wire for a client because his tax payment is like, you could have sent this 2 days ago, but. Just be careful because, today is the deadline for quite a few different things, John.
Yeah, I mean, it's like you would just want to hold on to those dollars to the very last minute. I'm just not ready to quite send it off yet.
Can we call it procrastination?
But look, just don't wait till the absolute last minute because sometimes if there's any sort of hiccup or something that delays that wire, if it takes just one business day longer than what you might expect, then you're just putting yourself in a bad situation. So just be like Frozen. Just let it go. Yeah, just let it go. Right. Just be like Elsie or whatever. Let it go. Right. But if you still have some things to do, if you're looking for some last minute deductions, either you're doing your own taxes or you're working with your CPA, and I appreciate you, Larry Smith, this morning saying that you signed my name on your tax return. I probably wouldn't do that. Anyway, if there's some last minute stuff that you need to do, look, if you are on a high deductible health plan through your employer, and if you're able to participate or contribute to a health savings account, you actually have up till today to make that contribution for 2024. And if that's an individual, if that health savings account, if that's for an individual or just yourself, the contribution limit that you can put in is $4,150. If it's for a family, you can put in $8,300. And and I know this is Danny's favorite account. So if he's listening this morning, I know he's getting very excited right now. So a health savings account, the money goes in, you get a deduction. And then once the money is in the health savings account, you can invest those dollars. I mean, sometimes folks will leave some of their money in cash in the health savings account in case they need to use it for deductibles, co-pays, paying for prescriptions, whatever that might be. But then you can invest the dollars in the health savings account, longer term. And as that money grows in the health savings account and that money comes out for qualified medical expenses, it all comes out tax-free. So you get a triple tax benefit. The deduction when the money goes in, it's growing tax-free while that money is working for you in there. Then you take a qualified withdrawal, it comes out tax-free. So if you haven't made a contribution to a health savings account, that could be an option for you to do today. Traditional IRA contribution, you can make your traditional IRA contributions for through today for 2024. And here's what a lot of folks fail to remember. Maybe maybe with my spouse, so Shauna and I. So Shauna is my wife. Let's say she was not an income earner. She is, but let's say she is not. Let's say I'm the income earner. I can make a deductible contribution to my IRA, and I'm 50 years young, so I could put in $8,000 for 2024. Well, even if my wife doesn't have income, I can make a spousal contribution for her. So rather than just being limited to $8,000 for me, I can also make a spousal contribution of $8,000 for her. That's $16,000 that can go in as a tax-deductible contribution. Mm-hmm. Not a lot of people realize that they can make a contribution for a non-working spouse.
That's true.
Right?
And even though it's not deductible, you still need to get your Roth IRA. If you want to do your Roth contribution for 2024, that has to be done by midnight tonight as well, even though it's not deductible.
That's right. Yeah. So if you don't need the deduction, right, pay the tax now. And if you qualify, you have to watch your income limits, but you need to make sure that you can qualify to make that contribution to a Roth IRA. Hey, pay the taxes now, get the money in the Roth IRA so now that can grow tax-free. And then you don't have to worry about all those pesky required minimum distributions later down the road. It's a great point, Lance. Yeah, make sure that you get your Roth IRA contributions taken care of as well. So
just basically any tax-related contribution that you want to make has to be done today before close of business.
That's right.
And again, as John said, I wouldn't wait till last minute.
Yeah, don't wait till the last minute.
Because everybody's slammed today. So if anything happens to slip up, you happen to have a wrong, switch an account number or something, it happens, right? And something doesn't go out, you're kind of toast.
That's exactly right. Yeah.
Real quick about HSAs.
Yeah.
Let's say that because you were talking about you and your wife, and let's say that Shauna had been working at another company where she had an HSA. Then she goes to work at a new company that has an HSA. Can you roll HSAs over?
Yeah, so it's you can consolidate or bring those multiple HSAs into one. Yes, you can do that.
And how do you go about doing that? Do you contact your human resources department? Who does that for you?
Yeah, so you would want to reach out to your current employer and reach out to their benefits administrator just to make sure that the HSA will accept an HSA from another company. And then you would just need to reach out to the other company to say, hey, I want to bring this HSA that I have with my previous HSA provider to my current HSA provider. And then you just move. It's just a transfer.
Yeah.
And then when the dollars come into your existing HSA, you have it all consolidated in one. And then that just gives you even more dollars in there that you can invest longer term.
Well, not that you're just when it comes time to use the HSA, you're not trying to run down six different HSAs.
Less is more.
Right?
Yeah. I mean, we talk all the time. Look, I'm a spreadsheet guy too. I love spreadsheets, and I've seen some pretty intricate spreadsheets of all of these various accounts all over the place, and arrows and pointing and here and there, and where am I going to go to get money? Just start to consolidate. So yes, in short, you can consolidate your multiple HSAs into one.
Yeah, and just by the way, on that, having multiple advisors, multiple accounts, multiple institutions is not diversification. Okay, that's just a pain in the ass. That's all that is.
To be frank. Exactly.
Yeah. So diversification is diversification of your assets within your portfolio. And then, real estate, stocks, bonds, gold, whatever. Having multiple advisors, multiple stuff, multiple accounts just is a difficult process to keep up with. You don't really have a good handle on what your allocation actually looks like. And generally, more often than not, you wind up with overlap risk and a whole bunch of other stuff going on. So you're not doing yourself any favors by spreading your money across multiple institutions.
Well, and now for the person who is the creator and the manager of what I call the sheet,
the sheet,
you understand where everything is and how everything comes together, right? It's a beautiful, elaborate, it's a
work
living,
of art.
Breathing entity.
It's a work of art,
right? But what you have to start thinking about is, heaven forbid, if something should happen to you, will your surviving spouse or your surviving significant other, will it make sense to them, right? So many times, folks that I work with who have what I call the sheet, we start to consolidate and streamline, and it's for all the reasons that you mentioned, but also because they just want to set up things to be a lot easier for their surviving spouse. Heaven forbid if something should happen to them.
Right.
Yeah.
Well, or you have something like Hurricane Harvey, where I was working with a client that had a super elaborate spreadsheet.
Yeah.
But didn't trust, the cloud. So yeah, Hurricane Harvey destroyed his entire life's work.
Oh no! You have to start over.
So yeah, if you're gonna have the sheet,
yes.
By the way, keep your sheet in the cloud where it belongs. You got to be really careful how you pronounce that.
That
right?
is, yeah. I need a little bit more coffee to make sure I pronunciate clearly around that one.
So, all right, a couple other things going on this morning. Obviously. Thanks, John. Appreciate that. But yeah, so a couple of things we'll get into this morning, talking a little bit about, Treasury Secretary Scott Bessent was being interviewed on Bloomberg. And, one thing we've talked about here recently is about this turmoil in the bond market. And we went through a lot of discussion. In fact, we still have a video posted on our YouTube page about the basis trade and what's been going up in the bond what's been going on in the bond market. And it was interesting because everybody's kind of breathlessly waiting right now to see if this can get itself under control on its own, which it kind of appears it may be. We'll see, kind of see what's happening. But we're starting to see the volatility that occurred over the last week. start to calm down here a bit. So maybe the bond market's getting itself back under control. But Scott Bessent was doing an interview yesterday and said, hey, Treasury has a ton of tools to handle the bond market, basically alluding to the fact that the Treasury can actually do quantitative easing just as much as the Federal Reserve can. So he kind of made this allusion yesterday in this comment that if needed, that the Treasury can step in and start buying back debt as well to help calm down this bond market, what's been going on with it lately, just because of this whole kind of this blow up that's been happening. And really just providing liquidity to the bond market in general, which is, if you take a look at liquidity measures of the bond market, it's very, very low. Repo is essentially gone right now. The TGA account is getting drawn down. So again, there's just a real lack of liquidity in the bond market, which is also contributing to this kind of basis trade blow up. So we'll kind of be monitoring this over the next few weeks. But again, that was, and basically Scott Bessent was basically just kind of pointing a finger at the Fed saying, hey, if the Fed won't do their job, I'll do it for them. So we may now have a battle going on between Jerome Powell and Scott Bessent as well. So anyway, be interesting to watch. All right, we'll come back, pick up with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, have you seen 1923 yet?
Yes.
I have a major beef with 1923 on multiple levels.
The Real Investment Show podcast.
The stuff that was happening in that show would not happen to normal people ever.
We were watching that too, Shauna and my wife. This is so exaggerated. There's no way that this would happen in real life. This Taylor Sheridan, boy, he exaggerates it. I'm just like, just watch it for what it's worth.
Very entertaining. Just at the end of it, I was very frustrated at the end of it. I was like, after all they went through, can they just be together?
Yeah.
At realinvestmentadvice.com.
I digress. Credit spreads, though. But this is the issue with credit spreads, right? It's the 1923 version of credit spreads, which is we got to make it so dramatic.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of comments in the chat, kind of just following up on what we were just talking about a second ago. One of the questions was, John, can you have an HSA account if you don't have health insurance?
Well, no, you need to make sure you're on a high deductible health plan. So you need to have health insurance, and it needs to be a high deductible health plan in order to qualify to be able to contribute to an HSA.
And this is through your employer. If you're doing it on your own, you can't go buy you can't go out and buy your own high deductible healthcare insurance and then get an HSA. It has to be done through your employer.
That's a good question. I need to look at that. If you are a self-employed individual and if you have a private insurance policy.
Self-employed, I think you can.
Yes.
Right, if you set it up yourself.
Correct.
But what I'm saying is just just a private individual go out and say I'm not employed and I don't have health insurance, right, in this question. And so I go buy a high deductible health care plan. Can I also buy an HSA as just a private individual, or does this have to go through an employer or some type of corporate status?
It does not need to go through an employer. Like if I'm my own self-employed individual, I'm a sole proprietor. Maybe
Right.
like I'm my own self-employed individual, but I don't have employer based health coverage. But I go out and buy my own medical policy to cover myself and my family. And if that's a high deductible health plan, then through that, yes, I could go to, if my bank offers a health savings account, then I would be able to open that and make a contribution there.
Right. But again, you have to be self-employed.
Well, yes, you need to be
employed in some form.
You need to be, you need to be employed and you need to have some sort of a high deductible health plan in order to qualify.
Right.
Yes.
So another interesting question in the chat, and I hadn't really thought about this before, is says I asked my CFA about my IRS Rule 72T distributions, and they had never heard of it, which is concerning. But what is that, and what do you do?
So 72T, and that's so whenever you see things like a 72T, a 401k, a 403b, any of those call signs, as I say it, there's usually a tax code that's associated with that.
Right.
And so they're talking about the Internal Revenue Code Section 72T, which allows like if I have a traditional IRA, it allows you to take money out of your traditional IRA prior to turning 59 and a half, and you are not subject to a 10% early withdrawal penalty. But when the money comes out of that traditional IRA, it's still taxable. It's taxable income. It's just this allows you to avoid paying the 10% early withdrawal penalty. And basically, another word for 72T is substantially equal periodic payments. Yep. There's a tongue twister for you, which allows you, which means that if you set up a 72T, right, and you would typically work with your custodian, if it's Fidelity or Charles Schwab, if it's Vanguard, let's say you've got a traditional IRA, a SEP IRA, a rollover IRA there. Maybe you're younger than 59 and a half, and maybe you're in between jobs, you're in between opportunities, and you need access to capital. A 72T will allow you to, if you set up a 72T, those substantially equal periodic payments, it would allow you to pull money out of that IRA and avoid the 10% early withdrawal penalty. But the payments have to come out at least annually, and you must continue taking the distributions even if you no longer need them.
Yeah, I was going to say here's
the catch.
That's the huge catch.
Here
to
it
this.
is.
Yeah.
So the distributions need to occur for at least 5 years, or until you reach 59 and a half, whichever is longer.
Right.
So you could set this up, when you're 58, and when you turn 59 and a half, you still have 3.5 years left, give or take. So it's not that you turn this off at 59 and a half. You have to keep the substantial equal payments in place for 5 years, right? And there's a specific calculation.
Or if you set this up when you're 50, you think, oh, this is a good idea. I can get into my IRA. I can start getting money to live on. And you go, it's only for 5 years, so I'll be fine. No, it's now 9.5 years.
Correct.
Because you started at 50. So, once you're locked into this deal, it sounds great. And look, I've had people do this, and I've had clients do this in the past, and I have never seen it work out well.
Well, there was one time where I did see this work. There was this one time. So when I was back in Schwab, right? This was back in This is probably right before the Great Financial Crisis, and there was a client who needed access to their IRA, and this particular setup worked very well for her.
Yep.
Right. But but that's been the one time where this has made a lot of sense and worked out well.
Well, and again, where I've never seen it work out well is that you get into this, and then the market has a big correction, and you've got to keep making those payments during that corrective process.
Yeah,
and which exacerbates the downturn.
Yeah, it's basically you're setting, it's like an annuity from your IRA. That's in short, and there's a calculation, and you have to determine what the dollar amount is, and there's a whole formula behind it. So it's not like you just go to Fidelity and say, I want to set up a 72D distribution, and I'm just going to take out $30,000. It's not like a one-time thing. I mean, this is a very specific, structured income plan from your IRA that you have to follow around these guidelines.
Yeah,
right?
yeah. And again, it's there for you.
Yes.
You can certainly do it. And I just, again, you just need to understand all the pitfalls that come along with it. As with everything, right? There's no free lunch. You still got to pay your taxes on the money when it comes out. But again, you're locked into this, for a period of time. So just, want to time it right. If you want to retire at 55, maybe it makes sense, right?
Yeah, because maybe it acts like a bridge. Maybe you just need some income to bridge a gap until you're
till you're 59 and a half and get into everything else.
Right, or maybe you're waiting to receive a pension, right? Mm-hmm. So I mean, there are times where something like this could really fit in and make a lot of sense. It all depends on your own unique situation. But to Lance's point, there's no free lunch. There's always well, if you do this, here's what you have to consider, right? So you have to look at it's like the pros and cons, right?
Exactly. So again, it's just, but again, I think the more concerning part is that person's advisor didn't know what it was. So, it's kind of one of maybe there's the starting point. Right. Just saying.
Maybe seek a second opinion. That is okay. Yes.
I went to my accountant and asked what a 1040 was. They didn't know.
It's not 10:40. It's 11 o'clock. What are you talking about?
Exactly.
Oh, goodness.
Anyway. Sorry, just could not resist. So, all right. Gotta get, sorry, I tickled myself here. Anyway, kind of getting back stuff. One of the things that, John and I have been dealing with a lot over the last, couple of weeks in particular is, just all this volatility. And again, John and I have talked about this before on the show, and just, and generally when we talk about this, it's generally during little minor bouts of volatility, and we'll kind of just say, hey, calm down, it's fine, nothing's going on. But this is where it gets real serious, because one of the things, and I got this email yesterday, right? So we hedged our portfolios here on that big rally we had last week, which, by the way, markets have been rising for the last couple of days. We're not even back to where we were on that big Wednesday record, third largest rally in history surge, right? We haven't even gotten back to where that rally ended. So again, markets are just trading really kind of in a range right here. But we added a hedge to our portfolio. So I got this email this morning. It's like, well, I don't understand why you put this hedge in. You know, if we're going to hedge, why don't you hedge 95% of your portfolio? Because there's nothing wrong with the market right now. It's had a correction. It's consolidating. Volatility is coming down. Extremely negative sentiment on most fronts. So again, it's more indicative of potentially a market bottom, but I still want to carry a little bit of risk management in portfolio. So we have a short position. We've got a much higher level of cash now after doing some rebalancing in the portfolio, reducing risk, rebalancing positions. But again, there's no reason to go. And this is one of the two mistakes that John and I talk about a lot, is that people go all one way. It's like, oh my gosh, I need to short everything, right? And maybe that works out for you, but it's a binary bet at that point. You're absolutely making a bet that the market has to go down, and if you're wrong, you're wrong, right? So it's completely binary on your outcomes, and that's not the way to really manage risk in a portfolio. I want to, the tendency of the market will be higher over time, and so I want to give it that statistical probability. We're certainly working through kind of an unprecedented moment with these tariffs and things like that we haven't had to deal with and really it's not the tariffs. It's been the inconsistency of the tariffs. We got a tariff today and then stuff blows up, and now we're taking tariffs off and repositioning things to help support the markets, but we're still going to do tariffs potentially, but then we got to renegotiate all those. And so it's this on-off, inconsistency with tariffs that make it very difficult for markets to price, because again, it all has to come back to impact earnings. So, but again, when you have these periods of volatility, this is also where we start getting phone calls where clients are wanting to make more severe mistakes, right? And just hedge everything, just get me out of the market, right? Just those type of things. One of those is misunderstanding portfolio declines, and we'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of things to talk about with portfolio management and talking a little bit about mistakes that people tend to make during different periods of market volatility, market action, market moves. Just going back and forth in chat with somebody talking about they made a lot of money in gold. Good example. No, you've made no money in gold until you sell it. And this is the mistake that investors make over and over again, is that something runs up in price and then they get this idea. We saw this with GameStop and Bitcoin and all these other things is, I'm going to hold on, diamond hands. Remember this whole thing? I think gold's going to 10,000. That was a comment from the person in chat. Maybe. Not saying it can't get there. It might be 20 years for it to get there. I mean, it's taken from 1970 till 2025 to get to $3,000 an ounce, right? So kind of do the math. To get to 10, are you still going to be alive is the question. And the reality is that things are going to move up and down in price. At some point, gold is going to have, and some, it's interesting because people forget that everything reverts to the mean. It doesn't matter what it is. It's the dollar, it's gold, it's stocks, bonds, everything reverts to means sooner or later. And generally those mean reversions tend to be very long in nature, sometimes 5 to 10 years, sometimes longer. Gold's had very long periods of going nowhere. And then it has a great run. And then it goes for a very long period with going nowhere. So again, you don't make money in something until you sell it. It doesn't mean you have to sell everything, but just don't forget to take profits along the way. Book those profits, put them away, put it in cash, and then wait for an opportunity to buy it back cheaper because it'll happen. So again, the mistake though that investors make over and over again is like they get this vision in their mind. It's like, oh, if it gets to 10,000, I'm going to have millions of dollars. And it's the same thing with Bitcoin and everything else. Bitcoin got to 100,000. Now it's, 80, right? So it's had decent correction. Now's the time you want to start looking at buying it, right? It's going to have another move higher at some point. You can make some money with it. Just what happens with a lot of people though is they get into this, and then when it does correct, they wind up selling it at a loss or at a deeply discounted price from where it was because they never took profits along the way. And then they panic and they make the same investment mistakes over and over again. When things are moving up, we get very bullish on stuff and we think that, oh, this is never going to end. And then we start coming up with these nonsense theses to support the idea. Oh, it's de-dollarization, it's this, it's that, whatever it is. Whoever's selling the gold generally is coming up with these theses so you'll buy it. It's like, oh, it's, nobody wants the dollar anymore, so gold's going to go higher. No, actually, that's not the case. But gold is having a move right now because there's a lot of speculative trade in that, and we're seeing a lot of movement of dollars to chase a trade. That will end at some point, just like we've seen big moves in stocks end. When money chases it on a speculative basis, it ends eventually. Same thing with every asset class. It all ends, whether it's oil, whether it's stocks, whether it's gold, whether it's Bitcoin, doesn't matter. It all eventually ends, and you have these reversions to the mean, which give you the better buying opportunities anyway. And it's interesting that we all talk about stocks are overvalued, they need to correct, but when they correct, nobody wants to buy anything, right? But this is where you start buying stuff that nobody wants, and you sell the stuff that everybody wants. So just manage your money how you want, but that's just how markets work.
Yeah, I mean, there's a number of conversations, Lance, I've had over the last, this is all blending together, I think it's 2 weeks. Mm-hmm. Give or take, where many of the same conversations last year, 2 years ago, man, stocks are so overvalued. Mm-hmm. Man, stocks are pricey. If markets would just maybe come down a little bit, if I could just get some better entry points for equities. Okay, here it is. Now, could things become a little bit more? I think that's what folks are worried about.
Right.
That's what they're concerned about. It's like, yes, equities are at more attractive valuations than where they were, let's say, here towards the beginning of the year. So I think there is a camp of folks out there that want to put money to work, but I also think they're also very concerned that is there another leg down here, right? So for maybe folks who have been kind of waiting for an opportunity to put some money to work, I think there's this all or nothing mentality when it comes to investing. It's like they've been stockpiling some cash, or maybe trimming, raising some cash, positioning their portfolio to be more conservative, and they want to take advantage of this. I think a lot of people feel like they got to go all in. Right. And that's not necessarily the case.
Right.
Maybe just nibble a little bit. You'll get some additional exposure. So that way, if the market has some strength, guess what? You win. But if the market has some additional, move to the downside, and you've kept some cash back, then you win, because you're able to take advantage of that potentially lower movement down, to get things at a better value. So I still find that it's like this all or nothing approach. And I think folks are very torn right now trying to figure out what is their real risk persona. Because many of you that I visit with, they, none of us know how long we're going to live. But even folks that we're in our, we're 60 years young, 65 years young, 70 years young, you may have another 20 or 25 years that this portfolio needs to support you and your family. So, does it make sense for you to have some of your money in equities? Because a lot of you are voicing your concerns about inflation and trying to keep your money growing to fight taxes, fight inflation, keep up with your purchasing power, and do the things that you want to do. So there's some of your portfolio that should be tilted towards growth. But then as soon as markets crack or show some volatility, it's get me out, get me out, get me out, get me out. Well, hold on a second. So now I'm hearing from a number of you like, well, just put me in T-bills right now. Just get me in T-bills, get me in T-bills until this market settles out. Get me in T-bills until the market settles out. Well, then when the market settles out, you may have missed all the opportunity, right?
Well, this is the psychology, right? Yeah. Another one we get a lot is that, I'm down so much from where I was in March, right? And then you look at it, it's like they're down 1% from March, March peak. And the market's
less
down
than 1%.
15. Yeah, the market's down 15. But again, it's that this is where we pick up loss avoidance. What you're talking about is get me out. It's loss avoidance.
Right.
And it's all fine as things are going up. And again, we get locked into these trades. And look, there's nothing wrong with any of these commodities or stocks or bonds or anything else. But everything goes through a cycle. And you just have to understand what part of the cycle that you're in and keep it in context of time frames. Again, you take a look at an asset right now that's just virtually going parabolic. It's like, I've got to get in because I'm going to miss out if I don't get in. That's that psychological issue. When it reverses, and it will, then you're going to get into the other side of this, which is now I've got to get out, and I'm never getting back into that asset again because I lost money in it. And it's just, you have to understand that everything, what goes up must come down eventually. And it doesn't mean tomorrow, it doesn't mean the next day, but again, it's just when you see how investors behave over time. And again, I've been doing this for over 35 years now, approaching 40. And, I just, you just kind of see the same behavior over and over again. And again, we deal with 2,000 families, 2,500 families. So we have a very broad base of individuals that we feed off of constantly because we get their phone calls and we're talking to them and we're communicating with them on a regular basis. And we hear all of these psychological tendencies that just occur repeatedly. And again, we have a group of clients who are our best indicators of market tops and bottoms.
Absolutely.
And because when they start calling, want to be all in or all out, that's a really good case because they're always wrong. They're always exactly wrong. So, they're a great barometer of human psychology. And this is just part that you have to understand is that what's happening in markets right now, this will pass. And everything that's doing well now will stop working well. And all these things that you hear about, dollar de-dollarization, it's the tariffs, this is all going to pass. The market's all going to factor this in, and the world's going to continue forward, and things are going to shift. So just make sure, again, this isn't a sell everything, this is never a sell everything moment. But the only way you make money in the market is to take profits along the way. And yes, you're going to pay taxes. And you can avoid paying taxes by not ever selling. But then you turn all your gains into losses. And so what was really the point?
And I think there's a real tendency right now to have that knee-jerk reaction to really position your portfolio to be very conservative right now. And there's a risk of that too, where the market is so, like, investors are so sensitive to headlines right now, Lance. And we've seen just as quickly as markets can snap down, if there's any sort of positive news, or if the news around tariffs is less bad than that was, compared to what was laid out previously, you could see some strong upward move to the market. So if you were to go to, let's say, an all cash situation, yes, I know you're trying to protect yourself from the downside, but you can also be giving up some opportunity to participate in upside, if there's some good news or things are just less bad than what investors think. Right?
That's right.
So just be careful. All I'm saying is just be careful of having that knee-jerk reaction right now.
That's right. And again, just, watch correlations. Those are very important. And when correlations begin to break, then that tells you that a shift is occurring in one direction or the other. And so just those that's the most important thing to watch. Whatever asset is you're trading, watch whatever correlation it has to the market or to a relative asset class. Because when those correlations are very high, that's good, and it helps support the move in the direction. When they begin to break, that's something that you also want to pay attention to as well. All right, wraps up the show for today. Be back tomorrow on Wednesday with Danny Ratliff, and we'll pick up with what happens with the markets today. Again, markets kind of opening flattish this morning. Again, not surprising. We're still struggling with kind of this consolidation that we're in over the last couple weeks. A very wide consolidation, but struggling with it nonetheless. So we'll just kind of see how this works out today, and we'll be back tomorrow. Have a great day.